So what I wanted to do at this point is talk a little bit about how a FICO score is actually calculated. Okay, so this is what's called a FICO pie chart. This is the 5 categories of how they calculate your FICO score. So what I wanted to do is just cover these 5 and I think this will probably fill up our time pretty well here. So the first category is past delinquencies. It's really the presence of anything derogatory on your credit report. That's what it is, which can be a collection. It can be a late payment. It can be anything 30 days or more that's derogatory on your credit report accounts for 35% of your credit score. Now, typically, if I'll, ask a group of people before I tell them it's 35%, I'll ask them and say, how much do you think your payment history is on your credit report? What's that worth in your scores? And usually people are shouting out 70, 80%, and all the rest is inquiries. Because, you would think that, it is the biggest category, but it's 35% of your score. Because remember, when they pull your credit report today, they're trying to figure out, are you going to go late again in the future? So past delinquencies, the past does predict the future. So here's what they're looking at. They're looking at how recently you've had a late payment. Because let's say, again, pulling the credit today, if you have a late payment that happened 5 years ago, does that really mean you're going to have another late payment happen in the future? It's an indicator, but it's not a really strong indicator because you may have 5 years of good history leading up to that, trending in a really positive direction. But what if you had a late payment a month ago or 2 months ago? That is going to hit your credit much more severely because it indicates you got something going on right now that you're having problems paying your payments now. You are much more at risk of going late in the future. So they look at how recently it's happened, how severe the payment was. Was it a collection? Was it a 30-day late payment, repossession, whatever it may be, and how often it's happening? Was there one slip up on a 30-day late payment, or do you have collections on your credit report? And by the way, medical collections, for most of the scoring models, they impact your credit just the same as any other kind of credit report or any other kind of collection.
Really? I thought that the medical was supposed to be backed out of the scoring model.
Well, here, let me explain something about the scoring models. Remember I told you there's a lot of scoring models out there, right? Think of scoring models like a Windows operating system. Like, remember Windows XP, Windows Vista, Windows 7, 8, and now I think we're in 10 now. People, when a new Windows system comes up, people adapt to it. They switch over. They take advantage of all the newest, latest, greatest things because the other stuff doesn't really apply to what's going on in today's world, right? Well, that's kind of how the FICO scoring generations happen. There was a model that was created in 1999. Actually, the first FICO scores were created in 1989. But in 1999, they created a mortgage FICO scoring model. That is still today the model that's being used. But since then, they came out with a FICO 8 model, a FICO 9 model, and a FICO 10 model that is hitting actually in summer and in fall this year. Those later models, the later generations of scores, are now treating medical debt differently because, again, they're trying to assess risk. I mean, here, getting a medical collection is not like you went out and bought a big screen TV and didn't pay for it. It's different, right? People don't ask to go to the doctor. But when in the older models, a collection was a collection, period. It's treated the same. Here's the problem when it comes to the mortgage world. And this is not lender by lender, mortgage broker by mortgage broker. It's industry wide. All mortgage companies are required to use the Windows Vista version of FICO scores that were created in 1999. That's a law. That is dictated by FHFA that controls Fannie and Freddie. All mortgages must be underwritten with those rules. No, so here's the problem from a consumer's perspective. When they see on TV that, hey, the new FICO model doesn't care about medical collections, or they devalue them, or if you pay them, they're a zero balance and they don't impact your scores. That's great. But remember when I told you that when you go to buy something, you have to play by the rules of that scoring model. When you go to get a mortgage, of collection is a collection, even though in today's, even underwriters will tell, the consumer, not the consumer, but tell the loan officer, hey, we don't care about the medical bills because it's not really part of our, we treat that differently, which makes sense. The problem is it's still impacting the FICO mortgage scores, just the same thing as if it's a big screen TV. A collection's a collection. So, and there are instances that a consumer, when they pay a collection, and some of these older models of the credit scores, you could actually drop your credit scores by paying off a collection, which is very counterintuitive to common sense thinking, right? And most people, when they think, hey, I want to buy my house, I want to improve my scores, I want to, let me just pay that collection so I can, I can buy what I want to buy. And sometimes when you pay off a collection in the older models, depending on other components in your credit score, you can actually drop your credit scores on a mortgage. And have you heard that or seen that before?
Oh, yeah. Yeah, a few years back, someone had brought that up or mentioned it to me and explained it, that it's the depth or age of your credit. And if you've got an old collection, sometimes that paying off that old collection may hurt you more than it's going to help you. Long term, it's going to help you, but short term.
And on these, and here's why in the mortgage world, the Windows Vista version, right, of the scoring models that are used in mortgages is, again, they treat them differently now. And because a zero balance collection or a medical bill is almost disregarded in some of these newer scoring models. What the balance on a collection in the mortgage models doesn't matter to the scores. It doesn't matter if the balance is zero, $100 or $10,000. Now, the bigger the balance, the more of a red flag it is, right? People are certainly going to ask questions about $10,000 versus $100. But in general, from a scoring perspective, the balance isn't an issue. What they're looking for and what the models are trying to figure out is how recently have you had collection activity? Mm-hmm. Because remember, today's date, what are you going to do here? If you have a collection that hasn't been active in 4 years, and let's say it has a $300 balance on it, and it has not been active at all, it's not the balance, the unpaid amount that's hurting the credit. What happens is that when a consumer makes a payment on that collection, making a payment on a collection is considered activity on that collection. So it changes the date of activity to the day that you made the payment. And while a consumer, and here I have to stress, I'm not trying to tell people not to pay their collections or debts they owe.
Right.
That's not legal, ethical, or anything. But here's the thing: don't do it always assuming you're going to improve your scores, because sometimes that's counterproductive and could drop your scores. Because when you have recent collection activity on your credit, then that can be an indicator of a problem and drop your credit scores now. And so that's the unintended consequence. The problem is, who's going to tell the consumer that? Most places, a lot of people don't even know that. Debt collectors certainly aren't going to say it. But the fact is that you have to understand these rules so you can play the game, so to speak. Yeah, right. It like a lot of things with credit, they make sense. You just have to, you have to be told how it works.
Right.
So, anyway, let me get to this part of the FICO pie chart, because this one's a really big part. The other components after this are pretty easy and quick to go through. Debt ratios. This is 30% of your score. Remember what I said on the payment history? It's 35%. This one's almost as big. Okay, it is a big part of your credit scores. This has nothing to do. This is not debt to income. Credit reports and credit scores know no knowledge of your income. They don't even know if you're working, for that matter. Has nothing. Your income has nothing to do with it. It's now, there are a lot of components in this category, but for simplicity purposes, it's your balances on your credit cards in relation to your credit limits. That's it. Okay. So the important thing for people to understand is that this is, it's a percentage, not a dollar amount. Okay. The scoring models are looking at how, if you have a credit limit of, we're going to use a dollar amount of $1,000. If you owe $500, your percentage that you owe is 50%. If you owe 900, it's 90%. If you owe 100, it's 10%, right? The scoring models are going to calculate the percentage that you owe. And the closer that you get to 100%, you are dropping your credit scores. So that's why you may hear, keep your balance under 30% or 50% or whatever. And it's, even FICO's, I think on their blog, they say, keep your balances at 30% or less on your credit cards. Okay, that is not the target area where people should shoot for. The right answer, and I was interviewed by CNBC about this. The actual best answer is 1%, because this is an algorithm. It's a computer. You're trying to maximize your score. So you don't have to be at 1%. That's the perfect number, but you don't have to be at 1%. I tell people, try to keep it at 5 to 10%. Call it 10%. That's a nice, easy to remember number. Here's the thing. 30% is better than 50. 50 is also better than 100, but being lower than 30, you can also see your scores start even improving more. So you want to target around 10%. Here's the problem. When people are trying to build their credit up or manage these ratios, and they have small limit credit cards, $300. If you have a $300 credit card in your pocket, and you use that for a month, and you just buy a couple tanks of gas and a few groceries, you're at $250 like that, right? So, and if you're at $250 divided by 300, that math, I think it's 80 to 85%. You're at 85% of your limit. Most consumers think, hey, just let me pay that on time. You know, what's the big deal? It's only $250. Well, that really mathematically is no different than owing $8,000 on a $10,000 limit. It's the percentage that you owe, not the dollar amount that you owe.
Not the, oh, that's interesting. Yeah, that I didn't know that. So the dollar amount, you're right. It's, you know, the $250 credit card, which a lot of people will get to start things up.
Yeah.
30% was a number I was always told. Keep it under 30%.
Well,
so,
and again, it's
better than 50.
It's better than 50, right? That's not the plot. That's not the spot you want to try to maximize. If people, you know, you want to tell people to be at 10%, 5% even. Now here, a lot of people will say, well, here, if the lowest percentage is the best, I'm just going to pay it off to 0. 0 is actually not as good as a single digit percentage. Okay. And here's the reason why. You have to think of it in terms of remember, they're trying to figure you out. The scoring models are trying to figure out, what are you up to? What are you likely to do in the future? What kind of choices are you making? And so you have to make sure that they're seeing clues of how you're using your credit, but not abusing your credit. So if your balance is 0, well, maybe you're not using it at all. Maybe you don't even have the card. Maybe it's in the drawer at home. Maybe you cut it up because you can't control yourself. Maybe whatever it is, the scoring models will look at it. Now here, certainly a $0 amount and 0% is better than anything that's too high, for sure. But it's not as good as showing a very small controlled percentage. And these small cards, these $300 cards, they can very much be traps for a consumer, because consumers think one thing: stay under the limit, pay your bill on time. And that's the recipe for success.
Yeah,
that is very, very insufficient information. You have to control that percentage, because here, if you charge up too much, you can pay every one of your bills on time, and you could see your scores drop anywhere from 5 to 50 points just by having too much, and sometimes even more than that, just by having too much of a balance on your credit cards. Okay. So there's 2 ways to do that, by the way, to control that. Always ask for the highest credit limit you can, and then pay down the balance as much as you can. Because here, if you owe $300 and your limit's $300, you could pay it off. Or if you get a credit line increase to $1,000 without even paying it off, you've lowered your percentage from 100 to 30. So there's a couple different strategies on doing that. So I know we're kind of getting to that 1 o'clock mark. So, I mean, there's more things I can talk about, or, you know, that's up.
Why don't we go through some of a couple of the other models, and then I have a couple of questions. You've gone through and answered almost all of my questions that I wrote down. So,
oh, okay.
Process. And we, you know, down the road, we can have you back on again as
Yeah.
well, so to go into some of the other aspects. But I wanted to make sure we hit the cares, and I think the scoring, how is your score made up is an important part. And
Yeah.
uh, we can
So,
kind of,
so maybe I'll just finish up these categories real quick here, because this is these debt ratios. Again, this is the single biggest thing that people can attempt to control with their own actions, other than paying on time or not. I mean, I don't think we need to tell people that you should pay your bills on time. I mean, maybe some people, but it's credit scores are grading what they see on that credit report. So that's important to know. Like, they don't know the story behind it. They don't know what happened. It's not part of it. It's a computer. So here, as far as these debt ratios or these debt utilization, there's two ways that they look at it: card by card and as an aggregate. Okay. The aggregate is the more important number. And what I mean by that is, let's simplify and say you have two cards. You have one card at $1,000 limit, and it's maxed out at $1,000. That one's 100%. Let's say you got another card that's sitting in the drawer at home. It's got a zero balance on it, but it's a $10,000 limit. That one's at zero. It's got a nice big limit. Okay. Now, card by card, you got one at 100, you got one at zero. But the aggregate percentage is going to be $1,000 balance divided by the combined limits of $11,000. So your aggregate percentage is actually going to be, I think, 1,000 divided by 11,000, 8%, somewhere in that area, whatever that math is. That's a really healthy percentage. Okay. So the point about that is, don't close credit cards. Don't ever, and people will do that, because here's what happens is that life can be good, right? Credit score is good, healthy utilization, you're at 8% because your aggregate is at 1,000 divided by 11,000. There are people that will say, hey, I'm not using that card, or if you never activate it or never use it, sooner or later they may close it. If they close that account, it's no longer part of your aggregate. Now your math goes from 8% down to 100% overnight as soon as that account is closed. So keep your cards open. Always get the highest credit limits that you can. One of the other, there's three more categories. These are really quick ones though. Average age of file is 15% of your score. What they're looking for is, how long have you been managing credit? You want to start getting credit as early as you can and keep managing it as long as you can. The longer history you give them, then it gives them more information to be confident about how they're assessing you as a risk. Not going to cover all this right now because I know we're running a little short on time. Mix of credit is 10% of your score. And by the way, as we keep going lower and lower, we started with 35%, 30%, 15%. We're down to 10%. We still haven't even talked about inquiries yet. So the mix of credit is 10%. This basically means, what kind of credit are you using? There's installment credit. There's mortgages, which are installment loans, but they're in their own category. And then credit cards. You should ideally be showing that you're demonstrating the ability to manage each of these types of debts. You're never going to have a really strong credit score if you don't have credit cards. Again, use them, but don't abuse them. If you don't have any installment loans, never had a car loan, never had a student loan, your scores are only going to get so high because you're not giving enough clues to the credit scoring model so they can figure out how you're going to manage different types of debts. Okay. So last one, inquiries. It's also 10% of your score. It's not as big of a deal. Oops, excuse me. It's not as big of a deal as people think. First of all, somebody has to have a permissible purpose to pull your credit reports. Okay. There's a thing called hard inquiries and soft inquiries. All the inquiries are going to stay in your credit report for 12 or 24 months. Only hard inquiries are calculated into the scores for 12 months. Now, what's a hard inquiry? Hard inquiry, the real simplest way to think of it, anyone that can extend you credit, car dealerships, mortgage companies, anyone that can lend you money, they're a hard inquiry. Generally speaking, anyone else is a soft inquiry. So if you want to, when we're done, you want to pull your credit as many places as you can find online, you're never going to impact your scores whatsoever, because those are all soft credit inquiries. They're still on your credit report. They're just not part of your scores. Now, I want to skip to this and kind of finish up with this. This is called deduplication logic. Also, inquiry compression. This is when people go to like a car dealership, and then they'll see that their credit scores were, or not their credit scores, but their, the car dealership shotgun their credit all over, and all of a sudden they got 15 auto loan inquiries, and that car dealership ruined my credit scores. And there's a thing called deduplication logic that's built into the FICO scoring models. Now, this is mandated by the government that said, hey, look, you're only going to buy one car. You're not buying 10. You're only getting one house. You're not buying 10 houses. So you have a consumer has a right to shop for things. So when you have all of the inquiries for one purchase, and this applies to three types of purchases: mortgages, auto loans, and student loans. That's it. Nothing for credit cards, nothing else, just those three categories. Any inquiry dated within a certain particular window, and that window can be anywhere from 15 to 30 to 45 days. Typically, if you use 30 days, you're kind of in that safe area. Call that your window. Any of the inquiries dated within that window of 30 days is all going to compress to count as one. So if you have one inquiry for an auto loan, or you have 25 inquiries for an auto loan, if they're dated in that window, for scoring purposes, they're all going to be combined as one inquiry and only count as one inquiry on your scores. It's called deduplication. Okay. It looks bad on your credit as a bunch of inquiries, but it's really not. So anyway, I'm going to stop there. And if there's any additional questions, and
what was the window? How many days?
Well, it depends on the model. Remember, there's a lot of models out there. I would just use 30 days on the mortgage industry. It's actually 45 days. Okay. But Experian only uses 15 days. So it gets a little kind of, so there's a lot of information on this. So for simplicity purposes, I generally will tell people, you consider the window to be 30 days and you're usually in that safe area.
Okay. Because that's a question that comes up all the time about.
All the time.
Well, I just had my credit pulled at XYZ lender. I don't know if I don't want all these pulls pulling my, so that makes sense.
And they'll tell the consumer that. Don't let anybody pull your credit report, because you don't want to drop your credit scores. What the real answer is that they don't want you to shop them. That's the real answer.
Yeah, I get that.
Yeah.
So my other multiple pulls on credit settles. So when you're talking, so if I've got a client that's got a collection and it's a charge-off credit card, they're looking at the credit card company says, hey, we'll give you 50% of the balance. We'll settle for 50% of the balance. That's going to cause an extra hit on their, it's going to hurt their credit more then, correct?
No, actually not. In here, the answer that I'm giving you is kind of in a vacuum. But there's a lot of moving parts. There's a lot of it depends type situations on these answers. But when you have a charged off credit card, and that's the damage is already done, right? It's not, and there's other reasons why it's paying a charged off credit card could actually be good for your credit scores. Now, remember, we talked about that special comment code, that narrative of settle for less than full balance. You already have something that's damaged. Putting a different code on there, you're not damaging it more. Okay. So in a lot of cases, and I don't like to give a blanket answer of yes, just pay that off. What I'd rather do is do a free analysis and answer that question specifically on a case-by-case basis, which of course, in the world of credit repair, that's what we do, is we help people work to improve their credit and credit scores. But in general, the answer of paying that off and swapping it out with the code of settled for less than full balance is not going to worsen the situation by any means.
Okay. All right. So since we're up against time, how's the best way for somebody to reach out to you? Obviously, I've worked with Jim in the past, and clients that I send to Jim are going to be people that are maybe at a 580 score and need to get their score above 600, 620, or I've had clients that are trying to get down payment assistance program. You got to be above a 640. So that's kind of your realm. How does somebody reach out to you? How does the process work for you?
Yeah. So They can go to our website at illinoiscreditservices.com. They can call my office at 630-427-8500. Or my email is kind of easy, jim@illinoiscreditservices.com. They can ask me questions, or I'll review their credit reports for them, give them a free analysis, things like that. But the bottom line of what we do as a credit repair company, and this is, there's no magic wand to this whole thing, right? It's just based on laws. And so the whole idea is, remember, the scoring models are looking for clues of anything good or bad that has happened and how things are trending. We try to work to change what's on that credit report by using the law. The law is called the Fair Credit Reporting Act. It basically says that, hey, since the consumer didn't put the information on their credit report, they have a right for it to be reported correctly and accurately, which means consumers have a right to ask questions about information on their credit report, which is what we do for them. And what we try to do is lessen the amount of bad things on the credit report and improve the right good things. Work towards having a better past that's going to predict a better future. So, and that's basically what we do and how we do it. But I always like to start with, hey, let's see kind of what's going, because not everybody needs credit repair. Sometimes they need some advice or information. And so again, I take a different approach than most companies, where it's more of an educational approach. And certainly if our services are necessary, that's what we're here to do and help people.
Right. Perfect. Well, Jim, I appreciate your time today. I know I have, there's probably some other areas we could have gotten into, but we can do that at a different time.
Yeah.
And I think the CARES Act information and just the scoring model in and of itself is a huge help or eye opener, because some of the things you went through, I've been doing mortgages since 2001 and I didn't know. So I learned something for sure today. So I'm sure other people tuning in have learned information. If nobody else has any other questions, I think we'll wrap it up. And we'll let Jim get about his business on this Friday. I don't know how the weather is in Illinois today, but down in Tennessee, it's pretty nice.
Yeah, it's a little chilly here today, but it's really bright and sunny, so it's not a bad spring day today.
Yeah, there you go. Well, I don't see any other questions. So Jim, I appreciate your time today. I hope you have a great weekend, and hopefully we'll get back to some kind of normal here down in the near future, whatever the new normal becomes.
Right. Okay. Thanks for having me, Roy. I appreciate it.
Yep.